Okay, so now we're going to get into our building analysis.
So for this week's building analysis, this is a property that is not on the market. It's a 40-unit apartment complex in the city of San Pablo. And ironically enough, this was a property that I first got sold back in 1999 and then resold back in 2004. And just a little bit about the property. Let me open up my screen here. It's 40 units comprised of 8 one-bedrooms, 24 two-bedrooms, and 8 three-bedroom units. Now, I started calling up old clients because from these videos that we're doing, I've actually had syndication companies or equity firms come out and give me a call specifically saying, hey, we see that you've syndicated properties. We have $5 million or up to place as equity, pari passu with you. We're looking for 8% preferred returns and an internal rate of return of 20% over a 5-year period, meaning they want to be able to sell out in 5 years. I'm not going to get into all the dialogue behind that, but this was the impetus behind calling up these old clients. And so the clients, they are interested in potentially reselling the property. The price is not completely set yet, but they're talking somewhere between 13 million to 14 million. So I haven't gotten all of the latest information on the property. So I'm kind of basing this on old information that I had from 2004 and what I know market rents to be right now. And based on that, let me just open up my trusty spreadsheet here. Again, I'm just kind of applying market rents of about $2.60 a square foot over the existing units. And I'm currently using a number of about $97,240 a month of income. I haven't gotten the information yet, but based on the price points that the owner was telling me, I'm just kind of extrapolating the income and then what the expenses are. So most of the expenses should pretty much be similar to what I understand about the property from years past, with the exception of inflation. And so when you apply that along with the new ad valorem tax rate, for those of you who don't know, the ad valorem tax rate is a property tax rate specific to each city. And I always advise any of my clients or agents, when they're looking up tax rates, look up the public records, the assessor's parcel number of that specific property, find its ad valorem as well as its bonds and assessments, because that one doesn't change. And so I've applied all of these expenses, and I'm using about a 38.23% of that income as expenses after applying a 5% vacancy factor. Now, I know this property over several years, and it probably doesn't even have a 5% vacancy. But again, for underwriting purposes, it's important to use the same vacancy factor that a bank would use to determine how much debt the property could service. And this is regardless of the fact that the actual Bay Area vacancy might really be like 2%. The banks, they're conservative. They have the money. So unless you're going to buy the property all cash, I'd advise use what the banks are using to underwrite property. So that all said, if we're looking at an income of $97,240 and taking 95% of that number as its effective income, applying its income from laundry, then instead of using an annual income of $1,166,000 a year, we're actually going to use a discounted effective income of $1,118,000 a year. And this is based on the point of buying the property at $12,500,000, which is kind of a happy medium from what the owner just anecdotally threw out as a number that they might be looking at. Now, based on that and these expenses that I generated, I'm getting the property coming in at about a 5.5 cap rate. That means if my calculations are right, and that after all expenses subtracted from the income, I'm getting a net operating income of about $690,600 a year, and I use a $12,500,000 sales price, then I'm looking at about a 5.53 cap rate. Subsequently, when I apply debt to this property and I take 70% loan to value on a $12,500,000 loan, and I apply what I believe to be an interest rate applicable to borrowing $8,750,000. So in this case, I'm using 4.125. In prior episodes, as we discussed some of these more expensive properties where you're commanding a debt of in excess of $3 or $4 million, $5 million and higher, what a lot of people don't realize is that the rates tend to drop. So whereas you might be paying 4.5 to 4.8 for a loan of like $1 million or even higher for a loan of $700,000, the higher you go, $5 million on up, the rates tend to drop. So even using a 4.125 interest rate to determine the debt service coverage ratio, that's a little bit conservative as well, because you could actually get it as close to as low as 3.9. Now, if I apply all those factors, you're looking at an income property that, from the start, if these numbers I'm estimating are correct, a property that should command a 1.36% debt service coverage ratio. For those of you who haven't watched previous episodes, what that essentially means is that the proposed monthly payment, in this case for borrowing a loan of for borrowing $8,750,000 at a 4.1 rate, amortized over 30 years, which is $42,406 a month, the net operating income would be 136% greater than that number. Lenders in this field are typically looking for just a 1.2 debt service coverage ratio, or the net operating income to be 120% of the proposed debt. So here you have a pretty healthy debt service coverage. Now, depending upon what the owner actually agrees to sell the property for and what my client actually pays for the property, that debt service coverage can go down. But so long as it stays above the 1.2 or greater, then it's a potential for a syndication, especially if it's a group of limited partners who are coming up with the majority of the down payment, and they still want to be able to see a preferred return on their equity outside of just the return after paying off the mortgage. Then, again, not to get too complicated, because I'm beginning to realize I am getting a little complicated here. It finds the property has a lot of potential upside, right? Now, again, I had kept earlier I had brought up about people preferred equity, people looking for an 8% preferred return, meaning an 8% on their equity or down payment, but also seeing a 20% over a period of time, right? Now, this 20% or internal rate of return is making at least 20% on their initial investment over in this case, a 5-year period of time. So to calculate that, what I'm typically doing is I'm applying rental increases. Now, again, we've talked about in previous episodes how it looks like statewide rent control is looming over us. And what's currently on the table, or has been passed at least legislatively, and is making its way down the chain, is a 7% annual rental increase plus a CPI. So that puts you at an average of 8%, 9%, maybe even as high as 10% annual rental increases. So I apply that to my monthly income that I'm estimating. And in this case, I'm using an annual increase of 8% a year. So 8% starting in 2019, 2020, all the way up to 2022. And what happens when I overlay that type of a rental increase over a 5-year period is, as my rents begin to climb, and my net operating income also subsequently climbs, provided that the market cap stays between a 5.5 or a 5% cap rate. Again, that means that investors at the time are willing to make 5% to 5.5% on their money. Then applying an 8% annual rental increase over a 5-year period of time could potentially have an unrealized capital gain on the property of about $4.9 million. That means if the purchase price or cost basis is at around $12.5 million, then just these little 8% rental increases over a 4-year period can potentially gain an equity as high as $4,961,000, or meaning that the value of the property has gone up to $17,461,000. So when I'm looking at all these different factors, and working with different clients, I'm always looking for an entry strategy, meaning that they're coming in at a return that would be comparable to what they or reasonable for what an investor should expect. But also, when you have limited partners looking to be able to exit in 5 years and make an internal rate of return of 20%, then I'm tracking that unrealized gain of equity over that period of time as we're increasing rents. So how do I keep that
Do you
simple?
have an estimate for the internal rate?
Well, if you have an unrealized gain of $4,961,000, then depending upon how that equity is cut, it's very easy to meet a 20% internal rate of return. Because if you figure that the investors are coming in the beginning at $12.5 million, then putting a 30% down payment plus closing costs, they're coming in roughly with $4 million. So over a 5-year period, they want to see a 20% to 22% return on their $4 million.
So in this example, they would make 100% return.
They would exceed what they're looking for.